we are going to discuss about journal entries. In every business, when a business transaction takes place, we have to record that transaction in the books of original entry or in a day book or in a books of prime or a journal. So we can say that this journal is a simple book of accounts in which all the business transaction is originally recorded in chronological order. So in a business, every business transaction should be shown in the form of journal entries in the journal. Wherever the money is involved, accounting is required to account for it. And this journal is used for the foundation of accounting. This accounting record is known as journal. It is mainly used to list all the necessary information about a transaction in one place. This is the format of journal. It mainly includes 5 columns. First one is date, second one is particulars, third one is ledger folio, fourth one is the debit column, that is we'll have to write the amount that is debited. Fifth column is the credit column where we'll be writing the amount credited. A narration which is relating to the transaction should be written in the particulars column to indicate what kind of transaction has taken place. Now we are going to discuss about the steps involved in journal entries. Mainly there are 5 steps that is involved in the preparation of journal. The first step is to analyze the transaction. Second step is selection of 2 affected accounts. That is, in a transaction there will be 2 accounts that will be affected. That is, one item will be debited and one item will be credited. So there will be 2 accounts that is affected. Third step is selection of the type of account. That is, the item that is debited and credited will be relating to a particular type of account. So we have to identify what type of account it is. Fourth step is apply the rules of journal entries. There are some rules for the journal entries. It is according to that we'll be debiting some items and we'll be crediting some items. Fifth step is finally entry in the book. So the last step is we'll be writing out the entry in the book of journal. So we can say that the process of recording transactions in the journal is known as journalizing or recording journal entries. So it is a process of recording transactions in the journal. So journalizing means we will be recording all the business transaction in the book of journal. So the first entry of recording the transaction is in the form of journal, and we'll be entering in the form of journal based on the double entry system of accounting. So according to this double entry system, we have classified the accounts into 3 types. So we are going to discuss about the types of account. Mainly we have 3 types of account. First one is personal accounts, second one is real accounts, third one is nominal accounts. Personal accounts means accounts recording the transaction that is related to a person or a group of person. That is known as personal accounts. So in personal accounts, we'll be recording only the transactions that is related to a person or a group of persons. The second type of account is real accounts. The accounts that is relating to properties or assets is known as real accounts. So real accounts means These are the accounts that is related to the assets or the properties. For each asset, we'll have to prepare a separate account. That is one thing that you have to note. The next type of category is nominal accounts. The accounts that is relating to income, revenue, gain, and losses is termed as nominal accounts. These accounts is also known as fictitious accounts as they do not represent any tangible assets like wages, rent or commission. So nominal accounts are those accounts which is related to incomes, revenues or gain or losses. So these are the three types of accounts. Now we are moving on to the golden rule of journal entries. So before moving on to the golden rules of journal entries, we need to understand what is this double entry system. In double entry system, every business transaction is having twofold effect of benefits. That is, one is giving benefit and one is receiving benefit. And this recording of transaction is done on the basis of these aspects. Double entry is an accounting system that records the effects of transactions and other events in at least two accounts with equal debit and credit. So the transaction will be shown in at least two accounts, that is one in the item that is debited and the other item that is credited. In journal entry, for convenience, we use DR, which is representing debit, and we use CR, which is representing credit. So in order to record the transaction, we need to understand the rules of debit and the credit that is relating to accounts. Both the debit and credit would represent either increase or decrease, which is depending upon the nature of account. So we are moving on to the golden rules for journal entry, that is the rule of debit and rule of credit. So in the case of personal account, the rule is debit the receiver and credit the giver. So in the case of personal accounts, the receiver will be debited, the giver will be credited. The rule for the real accounts, the golden rule is debit what comes in. That is, we have to debit that is coming into the company and credit what goes out. That is, the thing that is going out of the company will be credited. So that is the rule for real accounts. And the rule for nominal account is debit all expenses and losses, credit all income and gain. So all the expenses and losses should be debited and all the incomes and gains should be credited. So these are the golden rules for journal entry. Some examples are given. If goods is purchased amounting to rupees 10,000 for cash, what would be the journal entry? The journal entry will be purchase account debtor to cash account. So purchase account debtor to cash account, that is, purchase account is debited and cash account is credited. So debit what comes in, that is goods is being purchased. So goods is getting into the company. So purchase account is debited. Cash is gone out. So that is why cash is credited. The next one, purchase of goods amounting to rupees 10,000 from ABC company on credit. The journal entry will be purchase account debtor to ABC company account. Here purchase account is debited and ABC company is credited. The next one, sale of furniture amounting to rupees 10,000 in cash. The journal entry is cash account debtor to furniture account. So when furniture is sold, we'll be getting money. That is, it is an income. So the income should be in the form of cash. So it is a transaction which is relating to asset. So debit what comes in. cash is coming in. So we are debiting the cash account. So cash account debtor to furniture account. The next one, sale of furniture amounting to rupees 10,000 to be to Niveed. So Niveed account debtor to furniture account. I hope it's clear. So today we discussed about the journal entries, the golden rules, format of journal entry. Thank you.